in case of firms, LLPs, entries versus exit. So I'll request my coordinator, Aniket Kulkarni ji, to introduce it.
So CA Ankit Davda started his career early, and so he has more than 15 years of experience in unconventional services field. He's been actively advising various small and mid corporates on consulting, advising, and transactional assignments. His core professional area of interest and expertise includes tax, corporate, and security laws. He's been an active speaker on various topics at WIRC CPE. He has actively participated in inter-CA firm cricket tournaments too, organized by WIRC. So I would like to welcome CA Ankit Davda. So I would like CA Rahul Parikh, who is our Vice Chairman WIRC, to welcome Ankit Davda, CA Ankit Davda, with a moment. Thank you.
Hello. Good morning, friends. Hope my voice is clear. So good morning to all of you. I was just discussing with Rahul Bhai just a couple of minutes back that structuring deals in case of firm and LLP, while say if we were discussing this topic a few years back, maybe 2021 and before that, maybe there would not have been much to discuss about it, possibly, for the reasons we will discuss. There was an amendment in the law, and before that, I mean, as far as firms and LLPs are concerned, things were pretty straightforward in a sense. So I will just quickly take you through some of the important aspects. So in terms of law of session, we'll have basically we have bifurcated into broadly three buckets. One is a background, just to understand some of the key provisions under the Income Tax Act and some fundamental understanding about firms and LLPs, so that when we discuss about restructuring aspects, we are clear about like what provisions are applicable to firms, LLPs, or partners, so to say. And then as far as structuring is concerned, there are broadly two buckets again, like say you can do a structuring within firms and LLP. So to say, we are just restricting our structuring that firm and LLP will continue as it is even after the deal, which is subject matter of evaluation. And while there are certain avenues whereby we can do a lot of things within the firm, but often there would be a requirement that we may need to convert, so to say, structure the deal through a company structure. There could be commercial needs around that. So we will discuss those specific aspects. And then time permitting, some Q&A on the, if at all any of you have any questions, we can just quickly take it up. So quickly moving forward to background. So again, within background, we have this four line items, so to say, need for structuring, why there is something called structuring exist in the world in which we are living. Some key considerations while we evaluate a structuring of a deal. Then there are key provisions under the Income Tax Act and some basic concepts around firms and LLP. So this is what we will try to understand under the background concept. So why there is a need for structuring? Like say, for example, if you ask, and when we specifically talking about firm and LLP, generally you would see that there are small businesses, maybe SMEs, and mostly those entities would be carrying on business through a firm or LLP structure. Otherwise, most of the pretty well-established businesses would be running through a corporate structure generally. So then this topic of discussion may not be relevant in that case. So why there is a need for structuring? So like for a businessman, as a layman, he would just say that I want to buy a business, right? Say for example, there is a partnership firm is doing some business, he is looking for some investor, he would simply say, I'm getting an investment in the firm and I will conclude it. So there would have been no talk on structuring. But often when we actually work on such transaction, you will come across that there are various commercial objectives to be achieved. Often those objectives are conflicting in nature. Like say, while you may try to achieve one of the objective, other objective you may not be able to achieve it. So you will need to work around the deal that both the objectives can be achieved in line. Other times there are like avenues available, right? When we say structuring, obviously there are options available, and there is a general human desire to look for the best of the available options. Whenever you have a choice, you will look for best of the available options. So that is something where structuring would come into play. Sometimes it is inevitable because say for example, if you are looking for a FDI investment, it may not be permissible, or there may be restrictions in a partnership structure. So say you may have to convert that partnership firm into LLP, which again has some flexibility in terms of FDI investment, or maybe a corporate structure. So maybe to comply with regulatory requirement, it may be inevitable to do a structuring. And often, even if some of these aspects are not there, there is a human tendency to get maximum out of it. Like whatever is available, you will try to see how best, what maximum value we can extract in the process. So these are the things, cherry on the cake, as you can say. So having said this, the essence is like the structuring phenomenon. So to say, structuring of deals derives the relevance from the philosophy that how you acquire is as important as what you acquire. Like say what you acquire, a businessman would decide that something in terms of growth of business, he wishes to acquire XYZ business, or someone wishes to sell something. But how you do it is as good as, is as relevant as what you acquire or sell. So while we have discussed all these things, but it's very essential for the stakeholders involved that while you are trying to achieve all these objectives, you should not lose sight of the core objective. Like say structuring a deal would invariably means businessmen wish to acquire or sell business, right? So just we should not make it so complex, structuring a transaction, that the whole objective of deal may get defeated. So that objective we may need to keep it inside. So then key considerations in structuring, like say whenever we evaluate a structuring of deal, what factors that one should look into. So broadly speaking, there are again here three components which we will see. First is the monetary and cost factors. So there could be some attributes or parameters which will have monetary implication on the transaction. So something like income tax, all of us know, stamp duty, GST, there are transfer premium or other charges when there is a change in control, and sometimes there are contractual arrangements in a business. Then there are change of control clauses, while sometimes it could be procedural in nature that you just have to approach contracting party, the other party, to get the approval for change in control. Sometimes it could come at a cost. So these are the factors which we will need to keep it in mind when we structure a transaction. So you need to know, these are all technical things which as a professional we would need to be mindful about. As far as non-monetary factors are concerned, or so to say compliance of law, while some of these aspects may not have any cost implication on a transaction, but invariably you need to keep this in mind because these are compliance of law, something like constitutional law when we talk about from Indian Partnership Act or LLP Act 2018. If foreign investment is involved, FEMA, SEBI regulations, very rare in such cases, but if an acquirer, say the buyer or investor is a listed company, again some angle on SEBI law can come in. And competition law, like if business is decent enough, sizable, then competition commission related restrictions may come in, and permission from sectoral regulators. Like say for example, if there is any regulated business, then if there is a change in, because of deal, any change in control generally requires sectoral regulator approval. So RBI, SEBI, IRDA, FEMA. So while say you may be proposing a structure for a transaction, you will need to be mindful about all these parameters, because otherwise say a deal may be viable on one account or one count, but it may not be workable on other counts. So we need to have a holistic viewpoint of all these factors. And accounting treatment, while it is not appearing under first two categories, and being a chartered accountants and accountants, this would be an area of interest. Sometimes it's very obvious that there is an accounting treatment, what is in that. But point is, it could have monetary implications, and sometimes if it is as simple as just an application of law, it may not have a monetary implication. So we'll just see while we are going through some of the provisions or case studies, so to say, we will see how this can impact. So I think, and I mean, having said all these things, many of you would be aware that yet unknown risk of GAR remains. General anti-avoidance rules, as many of you would be aware, like whatever you may do today, while say the entire discussion which we are having today is subject to the fundamental understanding that whatever we are discussing, say it is there is a commercial need for that, rather than it is driven by tax considerations. So a GAR provisions would get attracted if you try to do something around any transaction or any event where your primary motive is tax saving or maybe tax avoidance or tax planning. If that is the primary objective, and coupled with other tainted elements, department gets a very extreme powers to recharacterize any transaction. Like say whatever you may have done, but department can say come and say, though you have done slum sale, we will not treat it as slum sale, it will be an itemized sale, or anything they can do if GAR is triggered. So point is, while we may be evaluating all those things, the fact remains that there is a commercial need, as we just discussed, that why there is a need for structuring. There could be regulatory restrictions since we need to do a structuring, otherwise the deal will not be workable in itself. While in the process, while it may not be a primary objective, but in the process you may get some benefit on tax front. That should be okay, but you should be able to establish that whatever we did, that was driven by commercial need, commercial substance, rather than the tax needs. So then some of the key provisions under the Income Tax Act relating to firms and LLPs. So there is a definition under section 223 of the IT Act. It says that firm, partner and partnership shall have the same meaning as assigned under the Indian Partnership Act or LLP Act. So there is no standalone definition under the IT Act. So whatever, these are the constitutional laws like Indian Partnership Act and LLP. So those person will become an assessee under the Income Tax Act in terms of firm, partner or partnership interplay around provisions whenever we discuss. Then there is section 10.2a, just pardon for that mistake. So it's a 10.2 capital A, where we share of profit from is an exempt income, as we generally know, while language used in section 10.2 capital A is share in the total income of the firm. When we say total income is little different, maybe it can be share of profit, but generally commonly we refer as a share of profit from a partnership firm. Then I think section 45.3, many of you may be aware about it. So fundamentally under section 45.1, when there is a transfer of capital asset, right? So that is a taxable event under the Income Tax Act as far as capital assets are concerned. And that transaction is taxable in the year in which transfer takes place. And then there are a whole mechanism around that from section 45 to 55 under the capital gain subsection. However, there are certain specific provisions, something like 45.3, which deviates from the standard or normal norm as we understand around working of capital gains. So what 45.3 says that when a person contributes some asset, capital asset in the firm, whereby he becomes a partner in the firm or he is already a partner in the firm, in either scenario, then like whatever amount firm records of that capital asset in its books will become the full value of sale consideration for the partner or the partner or the incoming person who becomes a partner. So point here is like say whenever we talk about structuring of a deal, as far as money is concerned, it is pretty straightforward. Like if you are contributing 100, obviously firm would account at 100, and effectively those are not capital asset. Money is not a capital asset. But if you were to contribute something else other than money, maybe say some valuable asset, something like land, some securities, then this section, this provision derives its significance from the fact that whatever, I mean, this is a special provision. So it says that whatever amount firm records, and when we say firm includes LLP for the purpose of Income Tax Act. So whenever we are referring firm or partner, it means of partnership firm and LLP both. So whatever amount firm records, that becomes full value of sale consideration for the partner, and partner will have to pay tax on that, whatever his cost of acquisition is there. Say for example, a partner had acquired some capital asset some few years back at 10 rupee. Now he transfer it, he contributes that asset in the firm, say at 10 rupee only. Maybe fair value is something else, and firm records that asset at 10 only. There won't be any tax liability to the partner, because it is deemed sale consideration, like whatever amount firm records, that becomes a deemed sale consideration for the purpose of section 48. So there are certain things which we can structure around this provision, which we will discuss when we go down. So this is a provision which is there under the law 45(3), which would be relevant when a partner is getting admitted in a firm. So maybe you can structure deals around that. And it's a this is a statutory provision which is conferred by law. So it's not something you are misusing the law. What law is saying, you are just doing it. Maybe we'll discuss that little in detail. Then there is a section 45(4), what I just referred at the beginning of session, that if you were to meet, say back in 2020, before this section was amended by Finance Act 2021, with in a way retrospective effect from 1st April 2020. There was a very clear law as far as partnership firms and LLPs were concerned. There were well-celebrated judgments, including the Mohanbhai Pamabai Supreme Court judgment of 1970s or so. The law was clear since 50 years that whenever a partner retires from the firm, whatever he gets, forget what is the balance in a partnership firm, what he is getting, it is a non-taxable event. Because it is generally said that partnership firm is not a separate legal person in the eyes of law. So like whatever partner is getting is his share only. So basically all partners are jointly holding that asset in a common vehicle. Now if partner is just getting out and taking his proportionate share, there should not be any tax on that, because he's just getting what belongs to him only. So this was the position before 1st April 2020. And you could do, I mean, lot of deals were structured around that, like maybe whatever maybe the capital balance in the books of firm, people used to structure around this, like whenever new investor comes, partner retires, there was a revaluation, partner would get, say, though capital balance is 100, he may get 200, 500, there is no tax on that. And it is a well established position of law. Though then section was amended in 2000 by Finance Act 2021 with retrospective effect of 1st April 20, because any transaction which took place during 2021 was got covered by this provision, was hit by this provision. So what it effectively says, there is a concept called specified person and specified entity under this section 45(4) and 9b. So whenever they say specified person, that means firm, AOP, BOI, but for our purpose, discussion in today's topic, we will refer it to firm. So specified person is equal to firm for our discussion purposes. Specified person is partner and specified entity is firm. So it says that when a specified person, partner, receives a capital asset or money or both during any previous year. So there is again this is a overriding provision to section 45(1). So generally under 45(1), irrespective of the fact whether you receive monetary consideration or not, moment there is a transfer, liability to pay tax arises in that year itself. So maybe you have transferred some capital asset, there is a deferred consideration. So long as that consideration is determined, you will have to pay tax in the year of transfer, though you may realize or encash this money down the line, say 2-3 years. So 45(4), again a special provision in deviation to 45(1). So it says that when a specified person, being a partner, receives any capital asset or money or both from the firm during any previous year, in connection with reconstitution of the firm. So reconstitution of the firm or specified entity is a defined term under section 9b. So effectively it means that I mean, say partners are continuing with change in PSR, though there may not be any admission or retirement, but partners are changing their PSR, so it will amount to reconstitution of firm. If one or more partners are admitted in the firm, in such scenario that one or more original partner continues in the firm, or one or more partner retires from the firm. While say there may not be any admission, but there are 4 partners, 2 partners retire, 2 partner continues with the firm, it is a reconstitution of the specified entity, or so to say firm. So there is a related concept which may not be, I mean, while we may not be getting into deep of that, but if there is a complete change in partners, say for example in a deed of retirement and admission, all partners are retiring and all new partners are coming, then as per section 188, there are 188, 187, it would amount to succession of one firm by another firm. It won't be a reconstitution, and both firms will be separately assessed. Like till the date all partners were there, and the new firm, it would be a succession of firm. So that is something we need to keep in mind. So coming back to this point again, there is a reconstitution of the firm. The partner receives capital asset or money from the firm. Then profits and gain arising from such receipt by the partner. So there is an so it says that there is a capital, there is a gain in the hands of partner because of this event. That is what section says, which shall be chargeable as income tax of the firm, though the income is earned by partner because he is receiving something from the firm, but that income is deemed to be the income of the firm, chargeable under the head capital gain, because we are talking about capital asset only. So we are not talking about business asset, which is governed by a separate provision, section 9B and all that. And it says that it shall be deemed to be the income of the firm of the previous year in which such money or capital asset or both were received by the partner. So here we need to be mindful that the taxation or tax liability will arise only in the year in which it is received by the partner. So there may be a reconstitution in year 1, there may be changes in the capital balance, but partner is not receiving anything in that year. So effectively there is no tax liability in that year, though that event is triggered, which would lead to taxation sometime in future when partner receive that money. But point is, taxation is in the year in which partner receive this either capital asset, money, or both. So in that sense, it is deferred. So this is a levy. I think hope we are clear on that. So basically it says that when a partner receives capital asset or money from firm in relation to reconstitution of firm, whatever income partner earns because of this, that mechanism is there, it shall be deemed to be the income of firm, chargeable under the head capital gains. And it is taxable in the year in which such capital asset or money is received by the partner. Now, how to calculate capital gain? So it is A equal to B plus C minus D. So it is a simple formula. B plus C is like value of asset partner is getting, money and fair market value of capital asset, minus capital balance. So it's very simple in that sense. And then it says that if you do any revaluation and if you increase the capital balance, then it will be ignored for the purpose of calculation of capital gain. So you can't just do a revaluation of, say, any existing asset or even account a new asset, self-generated asset, and increase the balance. You may do that, but it will not be counted for the purpose of calculation of capital gains. And then question would come that while firm is required to pay capital gain, but what is the nature of capital gain? So it's not linked to the period of holding of partnership interest, but there is a rule 8FFI which provides basis to determine whether it is a short-term capital gain or long-term capital gain. So it effectively says that whatever, so point is when this taxation would come, say B plus C minus D, only when partner is receiving something more than what is there in his capital balance. So point is why he is receiving something more, like commercially, say if other partners agree to give something more, that means there is some unaccounted or so to say inherent value in the business, right? Because there's something, if you have some historic asset at historical book value whose fair market value is much higher today. So there is some inherent value. So it says that increase, the amount which is subject to gain, that increase you need to attribute to the underlying asset. Like say if a partnership firm has land and if you are attributing that upside to the land, and if that land is long term in the hands of firm, then your underlying gain will be long term. If that increase is attributed to self-generated goodwill, it would be short-term capital gain in the hands of firm. So it is linked to the underlying asset, which is leading to this increase in value. And then there is rule 8AB, attribution of income to capital asset remaining with the firm. So while firm is liable to pay tax on this upside, there is a benefit available to the firm. So effectively what it says that that inherent increase in value, whenever firm sells in future that underlying asset, whatever amount that becomes subject to tax today, assuming that partner is getting some money in year one, that upside will be reduced from the future sale value of consideration. So say for example, there is a land having historic cost of 100 rupees. Now when partner is retiring, fair value is 200. Down the line 3 years, firm is selling that asset for 200 rupee. So effectively what firm did when there was a reconstitution, firm was giving that upside of 100 between original cost and FMV at the time of reconstitution to the retiring partner. So say if retiring partner was having 50% stake, so that 50 rupee will get taxed under 45(4), and that 50 will be deductible in future whenever firm sells that capital asset. So that is rule 8AB, like you have to attribute that upside to an underlying asset. Say if you don't attribute, it is up to the firm to justify that attribution through a valuation report. And if you don't attribute, then no benefit is available. So you have to be mindful whenever there is a liability under 45(4), you will try to see that increase is attributed to some asset at least. Though it may be a self-generated asset, maybe firm may need to pay higher tax being STCG, because say self-generated asset is a short-term capital gain and firm will have to pay 30% plus tax on that. If it is a long-term, it would be 20%. But at least that benefit would be available whenever there is some activity at firm level, whenever that asset is sold in the future. Whatever future sale consideration you will get, you can reduce this income which got taxed in year of reconstitution. 9B again, like the 9B, so basically law itself clarifies that taxation under section 45(4) and 9B is independent. It's not something like many of you would be aware, like how on first reading it may appear that there is a dual taxation, but you just see a scenario that 9B effectively says that when a firm transfers any capital asset or stock in trade, there is no concept of money here, just then it is effectively a sale. So you just see a situation that firm is selling a capital asset or inventory to a third person, then firm definitely would have paid tax on that. So it just says that even when firm transfers this capital asset or stock in trade to a partner, it shall be deemed to be a sale in the hands of firm, taxable under both heads, like stock in trade under business income and capital asset under capital gains section. And there is a whole guidelines on this 9B subsection 4. CBDT has come up with the guidelines. Any one of you can go through it, which talks about how to determine this taxable capital gain in such cases. Quickly moving forward, like partnership rights can be assigned. So as a fundamental principle, partnership rights can be assigned under the LLP Act as well as Partnership Act. Only limitation is that the assignee, transferee, will not get any right to participate in the management of the firm unless parties may mutually agree upon. Say if so, it is a statutory right conferred on a partner. Even so, deed cannot prohibit that because there is no enabling language under the Partnership Act or LLP Act which prohibits that you cannot, because it cannot restrict a provision of law. So in that sense, it is a statutory right confirmed. At the same time, there are protection available that the assignee cannot have any management rights. It will only have a right to get share of profit or right to share in asset or distribution. Second concept is partnership interest is a capital asset, well-defined provision, like what we just discussed. Before 2020, this concept may not be much relevant because often instead of doing sale or transfer of partnership interest, often deals are structured through admission and retirement. So you never had the occasion to see whether partnership interest is a taxable asset or capital asset, because
So there are these judgments, a very old judgment which says that partnership interest is a capital asset, and then a business undertaking, business as a going concern, is a capital asset again. So when you look at a combination of assets and liabilities in a business, bundle of those assets and liabilities is a business, while individual assets and liabilities, maybe say capital asset, business asset, or something else. And under IT Act, no distinction is made between firm and LLP. Yes? Just a minute. Huh? Nomination for? Yeah, that provisions are always there. Yeah, so the heir can become the partner like that. Or subject to understanding in the deed, heir can have similar rights, or heir can also be admitted as a partner based on the understanding under the deed. Yes? No, so generally you mean to say assignment is no. It's a voluntary act. Without your right, you have a right to asset under Constitution. So without your right, no one can assign it. No, then it would be, I mean, say there cannot be a forceful assignment of a right of a partner. Assignment deed. Yeah. You can. That assign him in the sense your son? Yeah. Yeah, but because say partnership interest, sometimes there would be restrictions, like say for example a private limited company. Yeah. Correct. No, I'm saying say like contractually partners may agree. Say three of partners join together to do a business. Even if they want that in future you will not assign rights in partnership without my consent, it cannot be so done because of the statutory right conferred by the law. Yes. Yeah, that could be possible because generally this section says that partnership interest in whole or in part, that language is also used in the law. So while as far as firm is concerned, firm would look into the in totality. Like say tomorrow you may have assigned your rights in favor of another person, while liability you may retain. But in the event of any distribution firm is concerned, firm will definitely first appropriate towards any liability. Then those rights may not prevail with this firm. So long as there are no issues, you can do that. That is what law reading of law looks like right now. Yes. Yeah. No, so dispute between the no dispute. Okay. Correct. Fine. Yeah, correct. That would be a capital gain. Yeah, so fundamentally, sir, like as we discussed, partnership interest is a capital asset. Now you can say since the time you are a partner in the firm, that was the original date of acquisition, technically speaking. But point remains, as we know how partnership account works, right? There would be fluctuations in the capital balance time to time. So maybe I think right now there is no much jurisprudence on that, but logically speaking, you will have to, even if you want to apply, so there is no bar on indexation. Like say on debentures, you cannot do indexation under section 48. There is no express prohibition which prohibits indexation in case of partnership firm. So maybe you will have to work around. like whenever there was a change in partners balance and maybe indexation you can apply. Right now, not much jurisprudence on this, because as we discussed prior to 2020, there was no taxation on this account. Things were simpler. Now, as we go ahead, we will have some idea on that. But principally speaking, as the provisions of law stands, indexation is permitted. Original date of partnership would become the original date of acquisition, long-term asset, and then indexation for each change in capital balance you will have to work around. Assignment date 2020 1st April. No, there's no distinction like that, sir. There's no cutoff date like that, because if you are doing an assignment out, then 45(4) will not come into play. Correct. No, so sir, there is no concept like grandfathering as we have for equity shares, because these are not specific provisions. Like say LTCG was exempt under 1038, then it was made taxable. There was a specific provision. So these are not specific provisions. This was given by judicial precedents. So nothing like that. No, he can continue to remain partner unless, say, you actually effect, right? Say when there is an assignment and it's a contractual assignment, then in normal case, what would happen? There would be a change in the deed, which would just reflect that instead of partner A, now partner B will be a partner, and whatever rights of partner A was there in firm will belong to B. Though, say, actual sale consideration may be different between A and B. That could be governed by a separate assignment deed. But if it is a voluntary transaction, with all parties agreeing, there will be a change in LLP deed or partnership deed, because otherwise you will not update the statutory records in LLP law or partnership act. And if you just assign your right, so it is as good as application of your income, right? You have some receivable, you are just assigning that right in favor of a person, so you continue to remain a partner in the firm, just that the other person has a charge over that receivable. In that sense, assignment would work. So maybe we can just quickly take it forward, because we have just 60 minutes of time, and this were the fundamental provisions which we just discussed, and I hope all of you have a degree of clarity when we discuss about structuring options. So now quickly taking it forward to second part of our discussion, like structuring deals within the firms and LLPs, and some of the questions which some of you asked would have some relevance when we discuss these points. So what could happen in a structuring of a firm within the firm, in the sense you are just looking at some deal, some investor is coming, someone is going, and there is within the firm you have to operate. So there could be a admission of partner, there could be retirement of partner, or maybe admission and retirement of partner. So we are not discussing a scenario where there is an outright sale of business by a firm in favor of any other person. So that would be a pretty straightforward thing in a normal course, where you have a slum sale of business, entire business is sold to a purchaser, and you have to follow 50B, Rule 11A, and work out capital gain and things like that. And maybe itemized sale, again, you will have the similar tax implications as applicable to an itemized sale. Like say you have a bundle of assets and liabilities, you are selling it on a itemized basis, individual assets and liabilities. Then there would be tax implication as applicable to each category of asset. So now quickly taking it forward, admission of partners. Quickly we have some 5-6 slides on this, and then few more slides on with company structure. So admission of partner. So fundamentally, say there could be an admission of partner in a firm so long as there is no change in the capital balance of existing partners. There are no adverse tax implications, right? Fundamentally, like say there could be a scenario where things are pretty straightforward. There is a business which is worth equal to the book value, maybe. The 100 crore net worth is there. You want to bring some investor, and you are valuing that business at 100 crore only. And that incoming investor wishes to acquire 50% stake. He will just contribute 50 crore, right? Partners would withdraw 50 crore because 100 crore net worth is there. So existing partner has a capital balance of 100, they will just withdraw 50 crore. A new partner has 50 crore, existing partner has 50 crore, business is worth 100 crore, both are having 50% ownership. So point is, so long as there is no change in the existing capital balance, or so to say balance of existing partners, no adverse tax implications under any of the provisions, things are simpler. But complications arise when there is a inherent upside in the value of asset which is lying with firm. So in this situation, you see balance sheet of firm before admission, there are these two partners having 50% share each, 25 capital balance. There is a corresponding land having a historical cost of 50 in the books. And then there are other assets and liabilities at 50. So we have a balance sheet, simpler balance sheet of 100. Now you see the fair value of land is 100 effectively. So now if I want to admit a new partner in this business, this is just a simplified example of land. You can equate this with any other business also. You can see an entire business as a whole, any land or any other asset in that sense. So point is, like say, while you may agree upon a fair value understanding, like what we just discussed right now, that book value is 50, fair value is 100, the incoming partner contributes 100 and is getting 50% stake in the firm. Right, so still things are fine for everyone, because right, say existing partners is worth 50%, because right now net worth is though 50 but fair market value is 100, and new partner has contributed 100 and is getting 50% stake. So now what is the limitation in this structure? While say if you do a revaluation in this scenario and you credit 50 rupees to existing partners, then implications under section 45(4) will come. Then there are, you have to see 45(4), 9B and things like that. But so long as you don't do any revaluation, don't do any change in the existing balance of partners, no tax implications. Only limitation which would be there in this scenario is there would be a higher book profit in future. Right, so we see land is, book value is 50, but contractually between partner, value is 100. So if say right from day one when new partner is admitted, down the line 2-3 years, that asset is sold for 200 rupee. Effectively, there is an upside of 100 only, which is to be said between two partners at 50-50. But since book value is 50, there would be 150 rupees of book profit. And as per PSR, it will get allocated to new partner a higher share. Say on 150 rupees, he will get 50%, 75%, while commercially he is entitled to get 50 rupee only. So there, while trying to address 45(4) situation, there could be limitations from future perspective, but at least you can avoid those implications immediately. And second thing is, often many of you would have seen, like in a partnership structure, when there are multiple businesses or multiple assets, people often structure PSR in that sense. Like say, you can always agree upon a PSR which says that whatever profits may come in future minus 50, and balance would be said 50-50, 50-25-25, and that 50 belongs to these two partners in 50-50 ratio. So these two partners PSR would be 50 rupee, INR 50 plus 50% upside. So that way also you can address this situation maybe, and there may not be a adverse tax implication possibly under any of these provisions. So this is one situation we just discussed. Now, taking it forward, like 45(4), 45(3), which we just discussed initially, dimming fiction is there, in the sense special provision is there. So how in restructuring we can use around this. So before we just discuss that aspect, a very important phenomenon which would play into account is whether section 50C CA, as far as transferor is concerned, and 56(2)(10) for the recipient, would override the provisions of section 45(3). Now 50C, many of you would be aware, like when a person transfers immovable property, land or building, and say original cost is 50 and ready reckoner value is 100, then 50C dim sale consideration is 100 technically. Right, similarly for 50CA for unlisted securities. And there is a corresponding provision under section 56(2)(10) for the recipient, that if a recipient receives any specified asset which includes land, building and securities, below fair value, then that difference is taxable as income from other source in the hands of recipient. Now question is, there is this section 45(3) as well in the statute, which says that when a partner or a person contributes a valuable asset, capital asset in the firm, and whatever amount firm records in the books becomes the full value of sale consideration for partner. Whereas we have this section 50C and C also in picture. Now both of these provisions are not overriding provisions for each other in that sense, in the sense what language has been used. But end point is 45(3) is there in the statute since long, whereas 50C, CA has come subsequently, 56(2)(10) from firm's perspective as well. So there is a favorable view, or maybe a more weightage in favor of the proposition that 45(3) will prevail, being a very more specific provision for partnership firm and partners, and 50C and CA should not have applications, and there are some judicial guidance on that as well. So for maybe you can, while there could be a lot of evaluation on that, but principally you can assume that 45(3) may prevail over 50C CA, while risk remains of department invoking 50C CA 56(2)(10). So how these provisions can be used in this situation? Very same example, 25 as capital balance, 50 land, other assets and liabilities 50, 100. Now fair value of this land is 100. Now a new partner is admitted in the firm or LLP, and instead of money, that person also contributes some valuable asset. So there could be situations like maybe a land parcel is there, right? Two adjoining owners are there. One owner is in the firm structure, another owner is in the individual capacity. Now they want to jointly develop this property. So that person who has an adjoining land parcel, he can become a partner in the firm. He can contribute that asset in the firm, which LLP Act and LLP Act specifically permits contribution of asset other than, so non-monetary contribution by way of capital contribution under section 32 of the LLP Act. And then there are rule 23 also, which says that whenever a partner contributes any non-monetary asset in the LLP, it shall be valued by a PCA, practicing chartered accountant or cost accountant, or a valuer. So it just says that it shall be valued. It doesn't talk about fair value of the asset. It doesn't say that it will be accounted at that value. The language is whenever, so partnership, the LLP will value that asset as per the valuation report. Now there is a lot of leeway over there. Until now, as we speak, there are no accounting standards which are applicable to an LLP. While partnership firm is complete flexibility, no such provisions. You can do a lot of things around that, re-evaluation and a lot of things. Even partnership firm owners can argue that no accounting standard applies to them, because what ICAI has prescribed is binding on chartered accountants, auditors. They may qualify a report, but under Partnership Act, there are no restrictions on us, so we can manage our office in the way we wish, and they can very well do things. So there are instances of revaluation of inventory as well, which generally accounting standard prohibits by partnership firms in past, with no repercussions, because there are no statutory framework around that. So now section 34A, which has been introduced under LLP Act in 2021, which says that central government in consultation with NFRA will prescribe accounting standards and standards on auditing as may be specified by ICAI. So ICAI's role is also there, which every LLP would have to follow. So I think ICAI has come up with an exposure draft on that, but it is yet to be notified. Until today, like this, LLPs are also not governed by any accounting standard in that sense. While law has come, it would soon come. So point is, when we talk about these provisions, 45(3), recording of asset by firm or LLP in the books, when you have a flexibility of non-applicability of a standard, and with help of 45(3), you can account a asset at a value which is more convenient to you. So in that sense, what will happen is that incoming partner also brings that asset, which is also worth 100 in terms of fair value. But the partnership firm accounts at 50 only. So as per 45(3), the partner will have to pay tax on 50 rupees minus original cost to him. As per 50C, CA should not have application. 56(2)(10) in the hands of firm should not have application in view of 45(3). and the partner, incoming partner also says 50% in the partnership form. So this is what you can work around without attracting implications under 45.4 of revaluation and things like that. So I mean, so much on the admission of partners, maybe 2-3 instances which we saw. There are, I mean, nothing much you can do around it when we talk about admission of partners in a firm. So now we talk about a retirement scenario, and then we will go into admission and retirement as well. That there will be a statutory document, sir. So you will have to do a transfer deed or conveyance deed, so to say. There would be stamp duty implications. So that things will be there. But sometimes, say, what happens if existing partners are only contributing? So under law, partnership firm is not a separate legal entity. So assets are held by partners on behalf of partnership firm. And many times people adopt that practical approach that the asset stands in the name of partner, meaning for the partnership firm only. And effectively, we don't need to do anything. But if there is a new incoming partner, you want to have clarity on title, certainly you will need to have a written document transferring that asset from individual person to partnership firm. You will have to pay stamp duty on that in Maharashtra 6%. And those implications would be there, definitely. Yeah, definitely. Yeah, so sir, point is, it's about 5-6%, which is a transaction cost, one of the monetary factor which we discussed, and versus maybe 20 to 30% tax implications which you may have otherwise. So parties often evaluate all aspects, like what is more beneficial to them, and then they can take a conscious call in that direction. No, so as I just mentioned, section 32 just is an enabling section which says that partners can contribute non-monetary asset. Rule 23 says that the partnership firm, whenever there is a non-monetary contribution by a firm partner to the LLP, LLP shall value the asset by a PCA or valuer, shall value. Now, if you look at the language, it doesn't say that you will have to account. Neither it refers to shall value the asset as per fair market value. Those language is not there. So flexibility around language is there. So taking it forward in terms of retirement, so we are maybe sort of time. So we'll just quickly, maybe Q&A we can take later. Otherwise, some fundamental concept we may miss. So we'll just quickly move forward. In terms of retirement, again, fundamental concept under section 45.4, taxation arises only in the year in which there is an actual receipt. So there could be a retirement of some partners, there may be a revaluation, but so long as that amount is not paid to the partner, there is no tax. Maybe contractually you can record that, partnership deed can record it, even firm can record that payable, but so long as firm don't pay that amount to the partner, there is no tax implication. So in that sense, it helps. So here same scenario like retirement of partner. Point is, whenever there is a actual payment, obviously firm will have to pay tax on that. And as we discussed under section 48, firm will get deduction of that amount whenever firm actually sells that asset. So be mindful that whatever amount becomes taxable under 45.4 is not a cost. So in that sense, you don't get indexation, but it is a reduction from the sale value in future. So there is a finer difference. So that deduction is available under section 48, the way we have cost of acquisition and cost of transfer. Similarly, this gets as a deduction from sale value of consideration. So now, say for example, in the very same scenario what we discussed, that there is a payable to C, right? So long as you don't pay, no liability. In the event you pay, in the sense firm pays, firm will have to pay tax, future benefit available whenever firm actually disposes of that asset. Now look at the scenario that this payable continues in the books of firm for few years. Say after a couple of years, maybe partner, the person who has retired, he assigns his right in the firm. So ex-partner assigns that right in favor of some other person. So what would happen? Section 45(4) is a specific levy which says that tax is leviable when specified person being partner receives from specified entity firm, then tax is there. Now moment partner assigns his right in the firm in favor of a third person, the partner would be receiving money from a third person, not from the firm. So technically levy would fail in that sense. While there is another view that when you assign, and if you ask partnership firm to record that in the books of LLP firm, so if you inform LLP that these rights I have assigned to X person and you record it, so effectively in the books of firm there could be a constructive payment because there would be a change in from payable to X partner to a new party. So then there could be a tax implications. So there are these two issues, whether it is taxable question, and if it is taxable, even though firm may not have paid, liability may immediately get triggered moment there is an assignment, because effectively you can see that firm is borrowing some money and paying of the retiring partner. So effectively there is a receipt by the partner. Yeah, there won't be any implication. So interest ideally, yeah, interest should not be covered by 45(4) because at the time of reconstitution an amount was determined to be payable. Now whatever you pay on that will not be effectively in connection with reconstitution, but yeah, maybe. Yeah, so only limitation would be there, Rahul bhai, whether firm would get deduction of that cost, whether it is a business expenditure. Second point, that income would get any case tax in the hands of firm. So these issues may come in such situation. In another situation, assume after 2-3 years that payable still remains in the books of firm and firm is converted into company. So again question comes, partner receives money after firm is converted into company, say even after 2 years. Now when company is paying that money to the ex-partner, again levy may fail because levy is on the specified person and company is not a specified person. Second thing, question could come when firm is getting converted into company, can it be said that firm is effectively making payment to the partner? Again, partner is not receiving anything because there has to be a receipt, right? Partner's right would get transferred from firm to company and with no control of partner on the firm. So maybe there could be levy may fail in some situation unless there is some amendment which expressly specifies that any successor entity is also liable. Yeah, that would be there. No, it can't be because you are not receiving, you are just permitting, right? So that is okay. I mean, say in that sense, when two companies do scheme of arrangement, right? You need consent from creditor or for that matter any banker. Doesn't mean that creditor is giving consent, his debt is discharged. So that consent is always subject to the condition that my rights would remain intact. The successor would remain liable to pay me. So in that sense, there can't be a constructive receipt in, to my knowledge and understanding. So, yes, ma'am. Yeah, generally it is done, sir. Whenever there is a conversion, all assets and liability become assets and liabilities of company. Yeah, it may certainly, sir. Certainly, so it's not as straightforward as we are discussing. Obviously, department would try to levy it, but if you look at the whole scheme of section, it says that receipt of money or capital asset by partner. So long as there is no actual receipt, levy would fail. And generally, under the law, that is a fundamental concept. You have to prove the levy. Recovery is separate, second thing, but so long as there is no levy, you cannot do anything around it. So again, another scenario like typical admission retirement, all this combination would operate 45, 3, 4, whatever other things we discussed. But in a typical admission come retirement, you just look at a company, right? When there is a company, there are say 2 shareholders for simplicity purpose. When any M&A is there, right? Simply a shareholder sells his shares in favor of incoming shareholder investor. No change with company, and under law we just calculate capital gain on sale of shares. You apply the same concept, same analogy to a partnership interest. The partner is assigning or selling his rights in partnership form to an incoming investor with no change in the books of the firm. Right, when there is, say, though net worth of a company may be 100, the shareholder is selling shares at 500 rupee, maybe fair value is higher, but company never accounts those increment or change in value. The company's books remains intact, only shares are transferred. So similarly, in a firm structure, partner is assigning, selling his right in favor of a new partner. Say partner, the retiring partner or outgoing partner may have a capital balance of 100. Fair value is 200. He may get 200 rupees from the incoming partner. Firm is not involved. There is an assignment between incoming partner and outgoing partner. Outgoing partner is getting 200. He will pay tax on 100. So, I mean, things are little simpler rather than involving 45(4) because then tax is on the firm. Here, like say, the person who is getting that gain, he doesn't mind paying it conceptually. 45(4) is a very unique situation where the partner is getting benefit, but firm has to pay tax on that. And you need to do a lot of permutation combination around that if you have to commercially agree upon a value. So in this scenario, the things would continue and the incoming partner would become a partner with no change. So whatever outgoing partner's balance is there, now it will stand in the name of incoming partner. So in the books of incoming partner, there is a mismatch. While in his individual book, his cost is 200, in the books of firm, it is 100. But so long as, say, there is a profit in the books of firm, it is attributed to partners in future, that gap will remain intact. If 100 will become 150, 200 will become 250. And that 50, the incoming partner would keep accounting as share of profit. So, in that sense, things are simpler. And whenever, say, this incoming partner wish to sell again in future, he can sell and he will have a higher cost in his books. So the like shares, you can keep doing around that. And possible tax loss in case of dissolution of firm. Because so long as firm is earning profits, it is paying tax on that. Partner is getting as a share of profit. There is no tax incidence on partner. And finally, there would be a mismatch in the balance and firm is dissolved, that partnership interest is extinguished. And if you don't receive any further money, there would be a loss in the books of, in the spanner in the works, in the sense, while things look good till now when we discuss about assignment, there have been discussions that when you assign a partnership interest, whether GST levy can come, whether it is a supply under the GST law. So there have been divergent views and law is not clear. However, I am aware of a transaction where a law firm had given an adverse opinion and transaction could not sail through because of this issue, because 18% GST is a non-workable thing. And there is a concept called actionable claim which is not subject to GST under GST law. So there is a counter view that partnership interest is nothing but an actionable claim. So there is a lot of jurisprudence on that. So if you are able to take that argument and withstand, that GST may not be leviable. So now, I mean, maybe 5-10 minutes more, Rahul, I think we can. Yeah. So quickly now, all about within firms. Quickly, we'll go through the with company structure. So there are a lot of limitations. You can't do merger of firms. You can't do merger of firm with company. Lot of leakages is there in firm LLP. So investors are not comfortable. FDI restrictions are there and not suitable for large business. So hence, we need, so while there is an existing firm or LLP, some investor is coming, he wants a company structure, so you will have to structure that deal around that. So what you can do, conversion of firm into company, there is section 4713, both are independent in a sense, there is an interplay between two as well, and there is a slump sale. So quickly 4713, or so to say, conversion of firm into company under chapter 21 of the Companies Act 2013, earlier part 9. So there are judgments and very clear position of law as on that as well. Tax Pin and many Umicore Finance and many other judgments which has upheld that so long as there is statutory, it is a statutory vesting and transfer under the law, the way language has been used under the company law. So there cannot be any transfer irrespective of compliance of condition of 4713. So while structuring such deals, often it is seen that we try to comply with 4713, but it has lot of limitations, immediate limitations, future limitations. So even if you don't comply, still your transaction may be exempt. So there are some restrictions like, because you know how the process works, on a final day, firm would become a company when ROC issues that certificate. So technically you can't make any changes in the carrying value of assets and liabilities. Technically it is a succession as the law stands. So maybe there could be challenges if you try to change any values in the process. However, if you do revaluation prior to that, maybe 6 months, a year before, and then firm is converted into company, then there are recently a Supreme Court has upheld, and there are other judgments as well, that such revalued cost becomes actual cost of acquisition for the company. And Supreme Court has just recently upheld, I think on 10 July a judgment is, Bombay High Court judgment, Supreme Court has upheld on that. So there is an ICI EAC opinion as well on that, on conversion. So in that also ICI EAC committee had opined that that whatever amount that company records on conversion may become its actual cost. Now if you have done some revaluation before that, maybe that could become. And be mindful that whenever there is a revaluation of asset in firm LLP without any corresponding change in partners or PSR, it would not be a reconstitution as per the definition. So there won't be any adverse tax implication in that sense. However, after conversion into company, if you were to sell these shares in favor of a prospective investor, then those shares may be a short-term capital gain in the hands of partner. So those things you will have to be mindful. Then quickly, 4713, like what we just discussed is chapter 21, assuming 4713 compliance is not needed. Now we go to a situation of 4713, things would remain same, just that you need to fulfill these conditions, that all asset and liability becomes assets and liabilities of a company, all partners become shareholders in the company in same proportion as their capital balance in the firm. There is no other consideration received by the partners other than shareholding in the company. So you can't, so there is a question, current account, loan account, how we do about, say in a partnership firm, you would have multiple accounts of partner, current account, capital account, loan account. So when this word current capital account is used, whether all these accounts are covered, then you will have to realign your partnership interest for desired shareholding in the company. And then there is a future condition. While condition 1, 2, 3 is immediate condition, when you are actually converting, you know you have complied with these conditions. But condition 4 is a continuing one, that partners should hold at least 50% in the company for next 5 years. While say on the date of transaction, you may comply with this condition, but down the line within 5 years, if there is a change in the company, new investor comes, he takes controlling interest, 51%. Then point comes that you will breach this condition. And Umicore Finance is mainly on this account that department tried to levy tax on this ground that 4713 was breached. Or some other judgments wherein courts have held there is no need to take recourse of 4713. 4713 exempts a transfer, right? So first there has to be a transfer, then assessee needs the benefit of exemption. So when you convert firm into company, there is no transfer. That is the legal principle. So there are favorable judgments on that account as well. And then 47A, what we just discussed, if there is a breach, there are multiple implications, like whatever gain was exempted, it becomes taxable. And for firm successor company also there are, because successor company would become liable to pay a tax, the benefit which were received by. So last slide, just quickly 2 minutes. Like conversion we discuss 4713. Now very simple scenario again, like firm is there. We don't do conversion, we don't do chapter 21 or 4713 benefit, maybe. We do a normal transaction. So partner is there, partnership firm is there, partners are holding 100%. Partners will form a new company with an intent to succeed the business of firm into company. So new company is formed. There is a slum sale, as we generally understand, normally, without taking recourse to 4713. partnership firm is transferring this business undertaking to the new company at a value what partners want to decide. And then prospective investor invest in the new company, whatever is the agreed shareholding ratio. Now say for example, this business is valued maybe 500, say for example, and investors are coming at say 40% stake, so they will invest 200 crore technically. So now if partnership firm is transferring this business undertaking for 200 crore to the new company, assuming we comply with 50B rule 11 UA, then what will happen in the books of company would account that undertaking at 200. There would be a payable to the partnership firm, right? Now whatever money investors infuse in the company, that 200, the company will use that to pay off to the partnership firm. Partnership firm will have to pay capital gain tax on that, long-term capital gain tax, with the benefit of net worth, right? Say while business is getting transferred at say 200, and if there is a net worth of 100 or 150 in the books, effectively you have to pay tax on 50 only, or maybe 100. And partner would get that entire 200 after firm pays LTCG if this undertaking is held for more than 3 years. 20% tax is paid. The entire money would be distributed to partners as a share of profit. So in that sense, you are extracting money at a very nominal cost, and with the benefit that the company would have the benefit of cost step up of that 200, which in general normal scenario these benefits may not be available. So LTCG, no tax to partner on withdrawal, and cost step up available. So what could be limitations over here? That when you are transferring business undertaking from firm to company, you are valuing that business say at 200 because that amount suits you commercially from overall perspective. Now investor is subscribing only 40% in that company, but investor is investing 200. So there is a value disparity. So there could be a 5627B risk. So that could be, so it may be workaround. I mean, say you partners can well plan it. They may transfer such business sometime in advance, 1 year, 2 year, and then there could be accretion in the value, and then you can justify difference in valuation. There could be stamp duty on slum sale, as we just discussed, because it is a normal transaction. While there are disputes on conversion of firm into company, even Maharashtra stamp duty department is trying to levy tax on that stamp duty. While there is a well-celebrated Vallabhi Patapi Rao judgment of Andhra Pradesh High Court, which says that when a firm is converted into company, it is a statutory vesting, there cannot be any stamp duty. There is no transfer, there is no conveyance. But we know of a fact, there is a writ petition filed in High Court, Mumbai High Court, and Maharashtra stamp department is levying stamp duty on conversion cases. And again, subsequent sale of shares in the converted, the new company may lead to STCG. So something of us can be planned that after 2 years shares are sold. Yeah, so this is all about. I mean, quickly, any Q&A? Yes, sir. Yes, sir. Okay. Mm-hmm. Sir, frankly speaking, this is a very complex thing which we have evaluated in one case. And I mean, I would say just to simply, because it would involve a lot of evaluation, because in fact, we have practically handled such situation. A partnership firm was there, 2 group of partners were there. There was a JDA with incoming reputed developer. He was not comfortable with one set of partners. He said, you just retire him, then I will come. And we evaluated a lot of things around that, because a project was sizable. You can't just make payment to the retiring partner right now. Again, there was an understanding that we don't want any monetary liability on the firm. We will only distribute future FSI or ready constructed flats. So there are a lot of complications around that when it would get taxed. Coupled with taxation on JDA, Lot of things are there, so maybe that would require a detailed evaluation, or maybe a whole session may be insufficient on that, sir. Yeah. Anything else? Yeah, unconventional PSR you can see. Yeah. No, I think that is what I just referred, that even before this 45-4 amendment, we had seen instances where there are arrangements which has different PSR understanding. Say if a firm has 2-3 business undertaking, 2-3 different businesses, depending on involvement of each partner group in each business, they have agreed upon a different PSR. So while partnership firm is fine, LLP Act, you may have some restrictions, because when filing forms with ROC, you can only give one PSR. There is no provision that you can give. Maybe you will need to attach a separate clarificatory note on that. But per se, there are no restriction under the IT Act. IT Act simply says that deeds should specify the PSR. So now it doesn't say it has to be a very specific ratio only, and flexibility is there around that. Yes. Correct. Yeah, you can do. Yeah, correct. So this correct scenario what we said as a new company, the way you said, if you're an old established company, obviously that would be a LTCG then. No, I mean, say there could be difficulties in the sense, so long as investor is not there in the business, a transaction is between firm and company, which has same set of shareholders or owners, so to say. No doubt it would have a risk of GAR as well, but so long as you have comply with 50B, read with Rule 11 UAE, right? So there is a specific anti-abusive provision. So long as you comply with that, the underlying value of business is 500. But so long as I am complying 50B, read with Rule 11 UAE at 200, maybe department may not be effectively able to challenge that evaluation. That is one thing. So there are obviously arguments on SAR versus GAR, special anti-avoidance rules versus general anti-avoidance rules. So issues remains, and the fact remains that underlying value of business is 500 only. So say if I were to divest my equity stake in a business in favor of a third party, obviously I would value this business as 500 only. But for slum sale, given that I am complying with a specific provision, I should be okay. And maybe some gap in timing, which with you can plan little in advance and then do it maybe. So last question, yeah. (47:13). Yeah, there is no specific condition. It just says that all assets and liabilities should be transferred. And there are instances, what judgment I just referred, that just prior to conversion or transfer, a firm had revalued assets, and then company claimed depreciation on the revalued assets. So some 6-7 judgment, some 35 crore revaluation was done. Original cost was 1 crore. A department challenged it. High Court appealed in favor of assessee that for 32, that cost becomes the actual cost, and Supreme Court has upheld that. Depend. I mean, generally as a book value, but if you want to do some fair valuation, you will have to plan little in advance. At the time of conversion, you may not be able to do it, as we just discussed. And all this remains subject to risk of GAR now since 2017. Yes.
On behalf of WIRC and all the attendees, I propose a vote of thanks to CA Ankit Davda. Ankit ji, you have really helped us take through legal aspects of structuring of LLPs and partnership firms. Thank you so much. And a loud applause to him. So we immediately start our next session. So thank you so much.